The world is falling apart. All major economies are at the forefront of their biggest crisis ever. From the US to China, from Europe to Japan, and all in between are facing quite dire consequences, which might completely change our way of life. In this video analysis, we'll go through all of these serious risks for the global economy and the slow but steady incoming recession or potentially a depression. At the end of the video, we'll discuss probably the best sector for protecting your wealth, which might also potentially help you profit in these upcoming hard times. Remember, knowledge is power, so it is best to prepare in advance. Hello friends and welcome to the Market Watcher, a place for gathering traditional financial and all other investment knowledge on a regular basis. As always, everything said in this video is with educational purposes only and should not be considered to be financial advice. Let's start with the country of the rising sun, Japan, and from there we'll go west. The biggest problems in Japan are two, and they are both very severe. The first big problem is the enormous debt burden. Japan is the most indebted nation with more than 260% debt to GDP ratio. Although being the second largest economy, Japan's GDP could be expressed as quite stagnated. At the same time, the debt is going much higher, much faster, which constantly brings the ratio of the debt to GDP higher and higher. A fun fact, so to say, is that Japan is the first country to massively implement the so-called MMT ideology. The MMT stands for Modern Monetary Theory, also called by skeptics the magic money tree ideology. It states that if a country is in economic trouble, we can just print money, lower rates, and nothing would happen. Japan is practically doing this for about 4 decades, and they have not experienced inflation or any type of severe financial consequences. The truth is, Japan is an anomaly. It is the only nation which has managed to create so much currency in proportion to its economy without having any obvious long-term side effects. But over the past year, the Japanese inflation rate has started to increase bit by bit, and now it is above the last decade's average, as we can see on a 60-year chart time frame. Today, Japan is seeing one of its highest inflation rates over the last 40 years. Only for a brief period during 2014, the late 90s and late 80s, the inflation was high or close to these levels. The great risk for the BOJ, or the so-called Bank of Japan, is if inflation breaks above the 5% trend line. Currently, around the world, the average inflation is above the 6% level. This means that from a global perspective, it would not be surprising to see Japan breaking the 5% level. If that happens, the interest rates must start to climb higher in order for the consumption to be lowered and the inflation to be stopped before it gets out of hand. The big question is the rate of inflation going to increase from here? And if we take the law of the pendulum into consideration, the more of a disbalance we have on one side, the more disbalance we will have on the other side. The problem is that with such high levels of debt for the main interest rate to go higher would be impossible. Another fun fact is that Japan basically invented the negative interest rate model. It was also the first country to adopt a long-term 0% interest rate level. To have negative interest rates means that instead of the bank paying you money for storing your wealth, there you have to pay the bank money, so this way savers are penalized. This mechanism is fighting off deflation and it stimulates demand artificially. It can be said that the real central bank government engineering has started off in Japan, or at least it has taken off with a bang here. On the next chart, we can see the long-term interest rate levels in Japan. Currently, the rate sits at minus 0.10. But during the 70s, 80s and early 90s, Japan had normal levels. The debt problem theme is not only specific to Japan, the debt problem is global and all major economies suffer from it, as we're going to see. Another big problem that Japan has is its incredible difference between the number of old people and the number of young people. On the screen now you can see how Japan's demographic tree looks like. They have an inverted tree. This is the worst kind of demographic buildup for a country. It shows us that the old are more in numbers than the young. But for a democratic and a social system to work, the young must help provide for the old. When the young here are so few, they cannot provide the economic output needed for the old to live a comfortable life. A normal-looking demographic pyramid is the best shape for such a demographic tree. This means the young are much more than the old, and in the near to mid-term future, their economic output will massively outweigh the economic drag which occurs when having an older population. Another bad thing for Japan, which is a good thing in general, is the fact that they have the longest living population out of any country in the world. This means that the old people will drag the economy for longer. A place which has very similar problems as Japan is Europe. Here the same problems could be examined: a severe lack of growth, incredible debt issuance, coupled with a very big aging population. Because we just spoke about Japan's demographic issues, let's go through Europe's same type of problems. As we can see on the next provided picture, the demographic tree of Europe is not so inverted as the one in Japan is, but still the most wide areas are the areas where the population is over the age of 30, between 30 and 59 are the most of the population. This means that in a decade or so, the largest part of the population would be the retired or close to retirement tier groups. This will put a huge strain on the social security system of Europe. Nowadays, the young and the middle-aged people think that as long as they work and pay their taxes, when they grow up, their pensions will take care of them. But the truth is that the system cannot withstand the pressure from such a big old population, and the system would break. Just for context, take a look at Africa's demographic tree. This is the best looking kind of tree. The bottom of the pyramid is incredibly wide and the top of the pyramid is incredibly narrow. This means that soon the African economic output could blossom and the young generation will be multiple times larger as a percentage compared to the old. Another big problem that Europe has is its big indebtedness. On the next chart, we see the average debt to GDP ratio for all European Union countries. The current level stands at 88.1% according to data stemming from trading economics. One of the most important rules for becoming an EU member is to have a debt to GDP ratio of 60% or less. As we can see, this rule is totally forgotten and missed. Over the last 22 years, as we can see on the chart, there has been a time in which the debt level was less than 60% of the total GDP. Another big problem for Europe is its lack of innovation and technological progress. As expressed by the McKinsey Global Institute, which is one of the best analytical business companies in the world, Europe a century ago was a global powerhouse of innovation, but it has started to lose its edge. Today, despite some notable exceptions, many innovative companies are found elsewhere. Europe is falling behind in growing sectors as well as in areas of innovation such as genomics, quantum computing, and artificial intelligence, where it is being outpaced by the United States and China. Nowadays, all major technological breakthroughs come from China or the United States. A big reason for the lack of innovation is the over-regulated European markets. The over-regulation is a big drawdown for all business startups. When it is hard to start a business or when a newly started business has to comply with a lot of administrative paperwork, which can bring penalties if not done correctly, the business startups just do not start, or they just go to another jurisdiction where the regulations are not so crippling. So the global recession could easily start off in Europe. Another potential catalyst for this recession or global depression could be the emerging market sector. The main issue for all emerging market countries is that they all have severe debt burdens. As stated by Kristalina Georgieva, the chief of the International Monetary Fund, nearly 1/3 of all countries in the world would soon face a debt problem. The big issue for all of these countries is that their debts are mostly denominated in United States dollars. When a crisis occurs or when uncertain times occur, the value of the dollar rises. This is happening due to the fact that the dollar is looked upon as a safe haven asset. When uncertainty occurs, people turn to assets which in turn can protect them, hence they turn to so-called safe haven assets. When people buy more US dollars, this makes the dollar more valuable. When the dollar becomes more valuable in comparison to other emerging market currencies, you will need more currency to pay off the same dollar-denominated debts. This will lead to a lot of defaults for emerging market countries because they just do not have the ability to repay their US dollar-denominated debts with current account surpluses. For an economy to have an account surplus means that the economy makes more than it spends, in layman's terms. When the surplus is not enough or when the economy is in a deficit, the old debts are repaid with newly printed money. This drives the value of the emerging market currency even lower, the inflation level is brought higher and the problems become bigger. So one of the biggest global risks at the moment is an emerging market domino-style default. The last time something like that happened was in the 90s during the so-called Asian crisis, which led to the 1998 default of the Russian Federation, which led to the end of the dot-com bubble of the early 2000s in the United States. Check out our channel as we have multiple videos about each of these separate topics. The global risk could also start from China or the United States' housing markets. Both of these housing markets are experiencing slowdowns, and further rising of the interest rates will lead to more housing market pain to come. A risk for the global economy could also be a further crash of the US equity market, which is still in a historically overvalued spot. The average PE ratio of the S&P 500 index is roughly 16. The current level is sitting at close to 30. This means that either the price of all equities needs to be sliced in half, or it means that the earnings need to be 50% lower. Also, a combination of the two is possible, and to be honest, this is the most likely scenario. When looking at the S&P 500 PE ratio chart, it is best to look at the Shiller PE, which is showing the cyclicality of the market, and it is quite often a much more precise metric. This was our video about all major risks for the upcoming recession or potential world depression. Thank you for watching until the end, like the video, subscribe to the channel, and I'll see you in the next lecture.